Hey, what's up? I'm Russ, and on this channel, Dapper Dividends, we're all about money making money. So I was recently talking with my Aunt Evelyn, and she said she wanted to pick my brain about investing and kind of learn about what I do. So I had the thought that not a lot of people may have the knowledge or the know-how or even the time to pick individual stocks or individual companies, but still want to be dividend investors. So I have a really easy and simple way that you too can be a dividend investor without doing any research whatsoever. The answer is an ETF, which is a basket of stocks. All it is a fund that holds hundreds of stocks sometimes, and you get exposure to all of them in one shot by buying one share of an ETF. Now, according to Statista, there were 8,552 ETFs worldwide, and I picked 3 dividend ETFs that you can invest in, but do be aware that these are all equities. These are all stocks, so it's a little bit more risky than bonds or mutual funds. So while there is risk, it is on the lower end of the risk spectrum. And another little catch is that there's an expense ratio because this isn't for free, so you do have to pay an annual fee for the service of holding an ETF. So we want to keep expense ratios that are a little bit low. And also the S&P 500 current dividend yield is 1.69%, which over the last 5 years is almost 27% lower than the high in March of 2020. So we'd also like to see dividend yields on our ETFs that are higher than that current benchmark as well. And make sure you stick around until the end because we're going to see how these 3 ETFs compare to the S&P 500 ETF, SPY, over a 10-year period with total return. And with that being said, let's get to number 3 on the list, which is the Vanguard Dividend Appreciation ETF, ticker VIG. Now, this ETF is focused on dividend-paying companies with 10 plus years of increasing dividends and was launched on April 21st, 2006 and has a current expense ratio of 0.06%. So that means for every $10,000 invested, you're only going to pay $6 a year, which, by the way, Vanguard suggests is about 92.5% lower than the average of similar funds for VIG. And currently, this gives you exposure to 289 companies, with the top 3 sector exposure being information technology, counting for 24%, followed by financials at 14.5%, and consumer staples at just over 13.25%. The top 10 holdings account for almost 30% of this ETF, with United Health Group at the top with a 4.21% share, followed by Johnson & Johnson, Microsoft, Procter & Gamble, JP Morgan Chase, Visa, the Home Depot, MasterCard, Coca-Cola, and PepsiCo. So the current trailing 30-day yield is 1.81%, so just about 7% better than that of the benchmark at 1.69%, and at $157.96 a share is about 8.25% off the 52-week high. And another thing to look for is if the current price is above or below the net asset value, which is simply the value of all the securities held by the ETF. And if you can buy below the net asset value, you are getting a deal. VIG has a 5-year compound annual growth rate of 8% and most recently increased that dividend a hefty 16%. VIG pays their dividend every March, June, September, and December, which right now is $2.86 annually. Morningstar gives VIG a 3-star rating, while ETF.com gives a rating of A62. Number 2, Vanguard High Dividend Yield ETF, ticker VYM. Now, VYM will give you a more conservative exposure to high dividend yields, but this does exclude REITs or real estate investment trusts, as they forecast companies that are expected to pay above average dividend yields over the next 12 months. They then select those that fall in the top half, and they weight them by market cap, which is the stock price multiplied by the shares outstanding. VIM was launched on November 10th, 2006, and has a current expense ratio of 0.06%, which is the same as VIG and is of most of the Vanguard family of ETFs. VYM currently has 443 stocks, and the top 3 sectors are financials at 19.7%, healthcare at 14.6%, and consumer staples at 12.9%. The top 10 holdings account for about 23.5% of the fund, with Johnson & Johnson leading the way at almost 3.5%, followed by ExxonMobil, Procter & Gamble, JP Morgan Chase, Pfizer, Chevron, Home Depot, Eli Lilly, AbbVie, and Coca-Cola. The current yield is 2.89%, which is 71% above the S&P 500's yield, and its current share price of $109.45 is about 5% off the 52-week high and exactly in line with the net asset value. VYM's 5-year CAGR is 7%, which is the same as their latest increase, and they pay their dividend every March, June, September, and December, which is good for $3.20 annually. Morningstar gives VYM a 4-star rating and ETF.com a score of A. 92. And number 3 on the list is the Schwab US Dividend Equity ETF, ticker SCH. Now, SCHD only includes companies that have a 10-year history of increasing their dividend, and what I really love is that they focus on quality companies with sustainable dividends, which gives it a large cap tilt, and there are also no REITs included. Now, individual securities are capped at 4%, and sectors are capped at 25% as downside protection, and the portfolio is rebalanced every quarter. SCHD was launched on October 20th, 2011, and like VIG and VIM, has an expense ratio of 0.06%. SCHD currently has 104 holdings, with the top 3 sectors being information technology at 20.78, financials at 19.64, and consumer staples at 14.69. The top 10 holdings are Texas Instruments at 4.47%, followed by PepsiCo, Home Depot, Cisco Systems, Amgen, Coca-Cola, Merck, Broadcom, IBM, and Pfizer, and those top 10 holdings account for a whopping 41.5% of the fund's total holdings. The current yield is 3.32%, which is about 96% higher than the S&P 500 average, and SCHD's current share price of $77.24 is about 5% below the 52-week high and is a shade under the net asset value. Check out that 10-year CAGR of 34% and last raised the dividend 11%. They pay a dividend also every March, June, September, and December and is good for $2.43 annually. Morningstar gives SCHD a 5-star rating and ETF.com a score of A. 88. So how did these 3 stack up against the S&P 500 ETF SPY over the last 10 years when factoring in total return? And remember, total return includes interest, capital gains, dividends, and realized distributions. Well, they all underperform the S&P 500, but SCHD only by 0.11%, VIG was about 14% lower, and VIM the most by almost 25%. What's your favorite ETF? We would love if you would share it with the community in the comments below, and SCHD is basically about in line with the S&P 500, which is really cool because you're getting much higher dividends and that capital appreciation is hanging in right there. So it's why I made SCHD a part of our daughter's wedding portfolio fund with another ETF. To find out what that one was, click this video right here in this itty bitty teeny tiny box right next to my head. And if you do that, I will talk to you there.